One of the year's accomplishments in the legislature was the adoption of a plan to rescue the gigantic state teachers' retirement system from its financial distress. It had about a $74 billion deficit and had no way of closing it. And one of the reasons was that the state and local school districts and teachers themselves had been not putting in enough money all this time. But there's another reason as well, and that's because CalSTRS, as it's called, had lost a tremendous amount of money during the Great Recession and the investments that went bad. Stock market investments, hedge fund investments, all sorts of things. And just a couple of weeks ago, we found out that CalSTRS had lost $125 million in a Florida land deal. Now, why are these pension funds, and CalPERS is part of that as well, why are they making such risky investments? Well, it's because they have to make high-flying investment goals, about 7.5% a year, to avoid tapping their members and public agencies and taxpayers for even more money. So in a way, it's a little bit of a vicious circle. They take greater risks, they lose bigger money in downturns, and the taxpayers are on the hook, or the teachers are on the hook, or the school districts are on the hook. Somebody else is on the hook to prop them up. It's time for a little more common sense in pension matters. Not high-flying investments, not bailouts, not panics, but something that's a little more steady, a little more dependable in the public pension realm.